Alright, this is Bob Joyner here, and I want to cover something that I've seen a lot of traders do, and so it's more of a video about a warning, if nothing else. And that is that I see a lot of traders doing what some call bottom fishing, which is when a stock will gap down or move down, and they assume that it cannot go any lower, so they buy it long when the stock is low. The opposite, I've never heard a name for it, but we could call it dove hunting, and that's where something is flying higher, and so they short it, making the assumption that it's going to eventually fall. Um, and That's a pretty dangerous thought there. And I'm not sure what it's really based on because it's not based on any kind of a technical situation at all. So I want to discuss it in detail, a little bit more detail, and some possibilities of what's behind that thinking in this video. So I'm recording this video on Tuesday the 17th of November 2015 in case you happen to be watching this video later. But today Nuon made a gap up, as you can see. So this was Monday's closing price, this yellow line down here. So it gapped up a significant amount. We can just kind of follow the little data box there, and you can see the price opened up about 8%, over 8% higher than where it closed. So that's a definite big gap up, and some people make the assumption that this gap in here has to be filled, and that's not necessarily true, and it's definitely not necessarily true on the same day that the gap occurs. So that'd be kind of getting rid of one um, false idea there that gaps have to be filled. No, they don't. Okay. Um, so the second idea is what I called just now dove hunting, and that's where we see something going up and we assume, well, it's got to go down, right? And the problem with that is that it has no basis in, a lot of times it doesn't have any basis upon a technical reason for doing it. And on this chart, I've just got a plain simple, regular candle chart here on a 2-minute chart of Nuon, and I'm not showing any other indicators or anything, just looking at price action on this, and we can see it continue to go to higher highs. Now, in Day Trading Pro chat room this morning, I posted a buy at $19 on this stock, and that was pretty much after the open consolidation period, and it started to cross up to new highs and went above that open couple of minute 5-minute block of price there, and the market continued to kind of show a little bit of a move higher as well, and so that entry ended up hitting target very soon, but then price continued to go higher. Now again, what I saw a lot of people in the chat room doing, or not a lot, but I saw a few people dove hunting the stock and shorting it when it was up in this area here, or perhaps a little bit higher. Now, and again, I didn't hear any kind of technical basis for doing that. And then what happens, when the price goes against, what is the thing that most day traders do? Unfortunately, what they'll do is they'll add to their position. So, why do they add to their position when the stock failed, to show a profit on their short, for example? Let's say they even may have shorted it up here, assuming that we're going to pull back down to here or something. Well, when it doesn't pull back, what do? Instead of taking the profit that might have been there, and then price goes above them up in here, then a lot of times what they'll do is, well, I didn't take profit, and now I'm wrong, and I don't want to be wrong, and I don't want to lose money, so I'm going to short some more up here and create a higher average price in the hopes that it'll come down. And then what happens is it doesn't come down again, and you've added to your risk, and what you've done is you've changed all your focus, unfortunately at this point, away from the chart. And what you're focusing on at this point actually is the negative state that you're in, the negative emotional state, because you're stressed. So if you shorted it, for example, if you put yourself in this situation, let's say that you shorted it up here at 1951, and you didn't take profit when it came down here and showed you about a 1% profit, and now you're up to 1975 or 1978, and you place another short position to average up, your trade there. So what kind of emotional state are you in? And the more important question is, are you actually focused on the chart at this point, or are you focused on your emotional state and trying to manage your emotions at this point? And I think the answer is pretty obvious for anybody who's gotten themselves into that sort of a situation. And what happens is that the trader begins to focus on their own emotions and trying to manage their emotions and trying to stay calm, and they're in a state of anxiety as the trade continues to move against them and just keeps going to new higher highs. And then what they do is they end up even making possibly a bigger mistake, which is to not treat the day trade as a day trade, but to treat it as a swing trade, because they figure, well, I can't get out now. You know, it's really moved against me now. I really cannot get out now. And then the day goes on, and you know, all it has done is go higher, created stress, and again, the trader is managing their emotions. Now, again, the question is, why would a trader do this? I think it's because they make some assumptions and because they trade upon an emotional history, perhaps. The assumption I already mentioned is that price has to come back down. The fact that, you know, price has gone high, well, it's gone so high it can't go higher now, and then it goes higher. Well, it can't go higher now, it goes higher. Okay, and I'm sure anybody who's listening to this and has traded before has done this. They've got you've probably gotten yourself in this kind of a situation, or the opposite. As I mentioned, you're bottom fishing and price continues to go lower, and you think, well, it can't go any lower. Well, of course it can. No one says it can't go lower unless it's down to zero. So anyway, in this kind of situation, why would traders do that? They make the assumption perhaps that price has to come down, number one. The other thing that I think happens is that perhaps at some point in their trading history, they did a trade like this and it worked and they felt great. And perhaps it came down, you know, 5% or 10%. And when you have a big trade, a big win like that, even if it's not based on any kind of a technical basis for the trade, if it's just a lucky win, that big win, is an emotional big experience for you, and it gets imprinted in your history, in your mind, and in your ego hero mindset. And your ego hero wants to be a hero again and will trade emotionally based on that past experience, and get you into trouble. Okay, so just a couple of thoughts on this whole idea of bottom fishing and dove hunting, as I'm calling it here. And again, trying to offer some warnings to traders who get themselves into these kinds of binds. And it's good just to pause and think, when you're doing this, what is the technical basis for the trade? Because if you actually have a technical basis for the trade, then you also have a technical basis for the stop. So if we were to go back to the very beginning and just assuming, for example, that our trader shorted up here and did not take profit, well, where would their stop be? Well, their stop would have to be up somewhere above a new high of the day, because if it failed to go down and hit their target and then it made a new high of the day, if the basis of their trade was the high of the day, then a violation of that high of the day should have been the basis for their stop. So nothing wrong with taking that trade necessarily, as long as you also have a technical basis for exiting the trade in case you're wrong. Hope this video is helpful for you. Talk to you later.